All right. Hope everyone is well. I haven't been able to post and write as much as I would like to. We've been closing uh, this week, so I've been extremely busy. But I thought I'd organize a few thoughts, talk about the market, small caps, Brazil, Mexico, a few other thoughts here. The idea of changing your mind as well. So let's see what we can get through. I'm going to start with Lulu. So Lulu. Uh, this is a stock we've been bearish on for quite a while. And I'm going to try to pull up the post here where we talked about it back in March. If you recall, they reported earnings and Lulu dropped something like 15% after earnings. And, we changed our mind on Lulu yesterday. So I'm going to share my screen here as well, walk you through why that's the case. I'll talk you through some of the financials around Lulu as well. So, here's Lulu. You can see my screen. It reports earnings, just gets smashed around. And then around here, we say, hey, look, this is not worth buying. The reason why is because there was another asset in the market called Abercrombie and Fitch, ANF. And if you look at ANF, it's cheaper than Lulu. It's 18 forward PE now. Back then it was 16. It's got this quality called momentum. It's got very good trend. And so this is the reason why not to buy Lulu. I think the main point here is like the opportunity cost of capital. Can you find a better idea in the same category? And that's why we did not invest in Lulu back then. By the way, this is also true for PayPal. So a few months ago, there's a lot of buzz around PayPal. We looked at PayPal. It was around the same time, like around April or so. And, PayPal is a forward P of 14. There's another asset in the market in the payments category called PaySafe. It has a forward P of 7. And in that same time frame, this thing's run up 50% since then. I should have bought this one, but I should have bought ANF as well, too. We looked at the opportunity cost to invalidate the thesis of why we shouldn't buy Lulu and why we shouldn't buy PayPal. And the opportunity cost ideas both actually did pretty darn well. So we're trying to reflect upon that one. So what about Lulu now? So Lulu, quite interesting. So the meta story around Lulu is this death of the U.S. consumer, right? Retail sales haven't gone up in months. There's this concern around recession that keeps lingering in the background. And if you look at the Lulu chart, this is the same level it was back in 2020. Now the question is this a value trap? Is business deteriorating? Are they losing revenue and earnings? And obviously they've had issues with some increased competition in the athleisure category, slowdown in international growth, and their retail same-store sales haven't grown as much. But if you take a look at the financials, let's take a quick look at what we see here. This is 19.4 forward P, by the way, so it's still somewhat more expensive than Abercrombie, but that delta has closed so much, so that invalidating idea of Abercrombie just does not apply so much anymore, especially given all the damage that it has received, which means it's priced in a lot of bad news, right? So if you look at Lulu, it's expected to generate $9.8 billion in revenue and cash flow from operations, $2.4 billion. So let's take a look back in 2020. The last time it was at this level, at $3.9 billion in revenue, and cash flow from operations was around 670. So that's around about a third less cash flow generation, and substantially less revenue, and it's the same price. So I think that's quite interesting. We wrote this yesterday, so the consumers priced in. Retail sales came out and beat numbers. So thank you, Mr. Market, for getting our back again today. But yeah, look at Lulu, up 2.8%. I think the way to look at this is what's the asymmetry here, right? So what's my downside? Maybe it drops a bit further, and I think that's unlikely. It's actually at levels that we saw in the October 22 lows. So back in October 22, what was the zeitgeist? The zeitgeist was recession. We don't have a recession. We have fears of a slowdown, which I call normalization from a 6% plus GDP, which we saw last year, to a more normal growth rate. And we're seeing that recalibration happen in the price of Lulu. So meanwhile, look at the upside here, and I see potential for upside. And that difference, I think, is compelling. Stocks in general have been hammered, though. I mean, so when I look at that, I say, what's the best quality asset I can find in the category? I don't want to pay up for Costco. Costco Ford PV might be more expensive than Nvidia. And Lulu looks quite interesting. So we'll see how it goes. You know, we'll give it a year or so and lock in some long-term capital gains. So that's a bit on Lulu. What else? Small caps. Okay, this is another one we changed our mind on. So back on July 11th, that was 5 days ago, there's a big move in small caps driven by low CPI print. And well, why? Well, a low CPI print means that, hey, maybe the Fed has won the battle on inflation, so the Fed can cut rates. And small caps ripped. So our initial read on that day was that, hey, you know, maybe there's a pullback, you don't need to chase. And we concluded that based on June. In June, CPI print was benign. Small caps ramped as well. And we noted a few differences, trying to invalidate our hypothesis. Then the very next day, you'll see this right here. Instead of our morning chart book, we do that every morning. You can see it's posted 7:45 a.m. that day. And we notice is the magnitude and breadth of that move in small cap suggests a sustained rotation, which is exactly what we've seen. I mean, the moves in small caps are extraordinary. This is a good example where, you know, you don't want to pontificate. You want to look at the data. And in this case, we were looking at our charts. So here's one of the largest dealers in public markets, ticker ABG. I don't own it, by the way. I'm just showing you different charts. And we go through this. Look at this one, ASTH, medical business. Look at that move, right? These are small caps that are re-rating quickly. And so we looked through this July 11th, different chart book back then, by the way, of course. And we concluded that, hey, look, the breadth of this means the number of players participating was significant and the magnitude was significant. So when you see that, then it's not a one and done play. It's a sustained rotation. So, you know, the point of the Lulu example and this is like, you got to be flexible. You got to be able to change your mind. You have to find ways to invalidate your own ideas. I think that's very important. So what else? A few other things I want to comment on real quick. So the other piece I want to talk about is this idea of a negative momentum rally. So we have a momentum rally and a negative momentum rally. So a momentum rally is when the best keep working. Negative momentum rally is like a catch-up rally. It's like a worst to first rally. So we have both of those. When you have a momentum rally plus a negative momentum rally, that equals melt up. That's what we have. It's melt up. And it's important to observe and just acknowledge that because that's your first order reference frame to process information. If we're in a melt up, then you want to be cautious on shorting stocks, for example, and you want to wait for a melt up to stop. And we'll talk about what that might look like in a bit. But clearly we are in a melt up. I want to talk about factors in a bit too. Here's another thing. Let's talk about Mag7. This is something we do again every week and every morning. We're going through charts like this. There's a lot more we do besides the chart, but the charts are definitely helpful. So, you know, what's going on in Mag7? It's negative momentum rally. You're seeing momentum continue, of course, some recent pullbacks, but Tesla and Apple are the biggest winners. So the story is bigger than just Tesla. It's bigger than Apple and AI. Like even ARK and SoFi are rallying. That's just called negative momentum. That's the phenomena that's playing out right now. So just bear that in mind. You know, if you look at the Mag7 names, they've been taking a breather recently, right? So on this chart here, what you can see is I have a name. This is Google. On the right-hand side, I'm showing the 3-year trailing valuation of Google. This is one of the reasons I like Google a lot. The risk-adjusted returns, I think, are attractive. The valuations are not anywhere near its 2021 peaks as compared to other names. Look at Microsoft. it's just touched peak. It touched peak valuation, turned around, and sold off. This is a consensus AI name. That's why I don't own it, because my upside is capped. Also, very similar phenomena. Got back to its valuation, tagged the top, turned around. So this is a market where these Mag7 names need to propel forward based on earnings growth as opposed to multiple expansion. That's a key difference. Small caps can benefit from multiple expansion and earnings growth, which is why I like them. So look at NVIDIA. NVIDIA is actually not as expensive as compared to where it's been previously. It's arguably some relative value there. Okay. Amazon's been multiple compressing for years, and despite that, it's growing earnings at a rate so that it offsets the multiple compression. But if you want to get a general view on the direction of these indices, you should look at every single Mag7 name because they comprise 35% weight in the index. And in general, you will find that these tend to get overbought or oversold around the same time. You can look at these things, right? You can see that fully 3 out of 7 of these names are near elevated valuations. And you can validate this by looking at analyst price targets. Analyst price targets aren't terribly worth much, but when you see consistency, when you apply that analytical lens here, then that might conclude that a rotation is in order, right? So, I think it's worthwhile looking at the sector level as well. I mean, what do you see here? This is breadth expansion, right? When talking about breadth expansion, ever since we wrote this NVIDIA correction hypothesis, it was the day of NVIDIA's earnings, and I wrote, hey, look, people are going to dump their stocks to own NVIDIA because NVIDIA is cheaper and growing faster. And I thought that'd be isolated to only tech stocks. Turns out it's actually the whole market. Kind of amazing, the NVIDIA effect, like the LeBron James showing up to play basketball at high school. But that has stopped. It stopped when NVIDIA topped out here. That's the Cathie Wood top, that big red bar. You can see the Cathie Wood top right there. And that's when breadth started to expand. So the capital that's flowing in due to that re-rating released and, going up somewhat, but some churn, and that's helped the breadth expand. The real driver for small caps has been rate cut expectations. Look at the regional bank ETF. I mean, all these things just lifted. I mean, these gaps I do not think are going to close unless the Fed disappoints and does not cut rates in September. Right now, markets are pricing in 3 rate cuts this year, by the way. I think that's too much, but I'm actually of the view now that we do get rate cuts in September, and I've been in the higher for longer camp, for a long time. All of last year, we faded that. We were on the opposite side of Goldman, but I can see a modest insurance cut, not a full easing cycle. But look at energy. These names are breaking out. There's definitely a Trump bump effect at work here as well, right? Lighter capital regulations for banks, that's going to improve financials. The ability to expand operations and export natural gas is going to help energy sector. More M&A, et cetera, et cetera. So there's definitely an animal spirits here, although I think most of that Trump bump is priced in sometime this week. You got an RNC convention, right? Like Trump had the most priceless campaign ad this past Sunday. So I think it's fair to say that, the Trump bump is getting priced in and things are starting to get a bit sloppy now. Okay. So, what I'm seeing now is just low quality rally, and low quality will rally if you expect rate cuts. That happens all the time. Every time you start to see an improvement in conditions and the ability of these firms that are hanging on by their fingernails to get financing. But we are starting to see low quality and just kind of sloppy stuff going up. And usually that's like a warning sign as well. We got options expiration this Friday. That's very notable. Let me pull up a chart of Tesla, for example. I'll highlight why that's the case. So this is Tesla, and on Tesla, I've overlaid here options expiration dates. I haven't completed it for this segment here. You can fill those in, but what you'll notice is that when there's a strong trend into options expiration, you see generally a reversal of that trend coming out of it. You've seen inflection in the trend, right? Downtrend here, options expiration, up. Uptrend here, options expiration, down. This is a little alpha tip nugget for you. It's not perfect, but it's all about stacking edges and finding different pieces of insight. I have a theory of why this happens, actually. I won't get into that now. I've explained it before. But options expirations on Friday. The other thing I'd point out is that, you want to see where speculation is hiding. Where's the fast money hiding? I contend that it's hiding in Tesla. Elon's done quite a brilliant job linking himself to the Trump bump with his contribution announcements he made yesterday. His campaign's pretty clever move, right? He's trying to link Tesla stock to Trump's fortunes as opposed to like earnings growth or good valuation. I mean, this stock is more expensive than Nvidia, right? The margins are compressing. They got competition from China. They need tariffs, and they're selling the future and kicking out all their announcements. But this is also part of the negative momentum rally. I wrote about this negative momentum rally somewhere back here. I was like, hey, look, don't short Tesla because catch-up trades are in order, and that's exactly what's happening out. But there are limits to how far these can run. And the other observation on Mag7 is that we're seeing record call option buying in those Mag7 names. We saw that, I want to say like a week ago. That's called a gamma squeeze. That's YOLO money. When you see that, that's a sign that we've probably come too far. And of course, you're seeing the Mag7 weakness in those names where we had this record call option activity, right? If you go to my profile and type in gamma squeeze, you will see what I am talking about. So what else? The first weeks of July also have tremendous positive seasonality. So we're just coming off some tremendous positive seasonality. It's actually quite similar to last year, almost to the day. So gonna be an interesting couple of weeks ahead. I think rotations are a great idea. I think small caps still have room to run because of that breadth thrust, and also mid caps. My approach is to buy quality small caps because I don't have to nail the rotation, right? We were buying, and I wrote this all on Twitter, of course, but you can take a look. We were buying home builder HO. This thing's got a 4P of 7.7. That green line is when we bought it. Arguably, we bought it too early. Maybe you buy it here. But if I missed that, would have missed the whole rally. So, hindsight's always 20/20, but it's obviously done quite well. These are logarithmic charts, right? It's up 150 now. We bought it back there like 114 or so. And small caps can do very well, right? This is a stock in 1 year has done a 62% return, right? I mean, that's better than almost every Mag7 name except Nvidia. So, I think people chase these tech stocks because they think that that's where you make money. Well, if they're already expensive and overpriced and overbought and consensus, then the cup is already full. There's not much opportunity. I wrote about a small cap insurance company this weekend in the Lumina Ledger. I won't walk you through the thesis. This is a stock that's got a 4.5 PE ratio. They're buying back their stock. They generate loads of free cash flow. It's generated 167% return in 1 year. No one's talking about it, right? I think these opportunities are quite interesting. And again, you don't have to nail the rotation. You have to have a sense that a rotation might be coming that might cause you to focus more on small caps. But if you buy a high quality asset that's growing earnings, it's compounding, you can be patient. These aren't companies that are loaded with debt. Those companies are ripping also, by the way. That's more of like a trade, right? So here's a company called Hees. It's an industrial company. It's got $6 million in cash in the bank. They're trying to be Next United Rentals. They're doing a roll-up play with a lot of debt financing, and this thing is cranking. Look at this. This is cranking, right? Look at the one from like 42 to 54. What's that, like a 20% return in like a week? Tremendous. But this is an example of what I call like a small cap that's a call option, right? They have $6 million in cash. It looks like they'll get through to the other side. It's not like they have a big maturity payment coming up soon. We already did that balance sheet analysis. But if they get rate cuts and just a breath of fresh air and oxygen, then these small caps can rip. And, as you know, the Russell, the IWM has a lot of awful companies in there. They're loaded with debt. I'm focusing on the quality ones because they can compound and grow. But these other ideas are there also. These are more like tactics and trades, but I'm going to have to pay taxes on them. If I buy that thing, I got to pay taxes, short-term capital gains. If I own it less than a year, I doubt I'm going to own it for more than a year. So what else? Let's take a look at the US dollar. So another thing we look at quite regularly is the US dollar, the 10-year. I look at the leading themes in the market too. That's like semiconductors. I want to look at SMH, right? So here's the US dollar, right? So US dollar, the red line indicates weakness in risk assets. A green line indicates bull market. So dollar down, bullish; dollar up, bearish, right? And you had a dollar peak, and this has been rolling over, and that supported emerging markets, right? So take a look at Brazil. The reason why I'm calling this out is like U.S. markets are expensive now. The Ford P and the S&P is 21. Now there are pockets within the equity markets that are cheaper, like small and mid caps and select technology companies. There actually are tech stocks that I own and buying that you all would recognize. I haven't talked about this call here. Probably write them up in our newsletter later. But there are still opportunities there. But take a look at Brazil. So here in Jan 04 was when the dollar was at a different inflection point, and it's the exact opposite inflection point here. So let me see if I can find another chart for you. Right, and 10 years also worth looking at as well. The 10-year was at a low here. The dollar was at a low here, and now it's at a peak. That matters for a country like Brazil, which is a big commodity exporter, right? So they own Petrobras. They got a ton of oil. So if the dollar's expensive, that has an effect on Brazil and vice versa. So this is where we bought PAGs right there. This is beautiful. I love this one. So we looked at the ETF level to understand what the general pattern of Brazil is looking like with respect to US dollar. And, it's worthwhile looking at the holdings too to make sure you understand what this thing is owning. You see Petrobras in there as well, a lot of oil related companies. And then, we thought the best move was PAGs. So we bought that. This is PAG Seguera. I'm just summarizing with the ticker name. This is like the square of Brazil. So, if you kind of overlay that line I showed you here, we got that like right around there. This is a good example of getting a good technical entry with a thematic overlay with the right fundamentals. If you can line up all of that, if you can stack those edges, you're in good shape. So take a look at the financials in this business, by the way. This is a business I've been on for 10 years now, and that's important because I don't want to pay taxes. If I have to sell this thing in under a year, I have to pay taxes. I'm climbing up a hill. I'm going to lose 20% if I pay long-term capital gains, or I'm going to lose up to half if I pay short-term capital gains, right? So, and that's one of the key ideas from Buffett, and that's why he doesn't sell often. I think he should sell more often, but the general idea he has is a very good one, which is let your assets compound and get great businesses at a fair value. So, this is a business that, has let's go pull up some of the growth targets around this. It's cheap business, free cash flow divided by market cap, 23%. Think about that for a second. So this business is worth $4.2 billion, and it generates $1 billion in free cash flow. It can do a lot with that free cash flow. It can buy back stock. It can invest in growth. Right now, they're choosing to invest in growth and kind of a modest level of buyback. The price free cash flow ratio is 4.3. It's dirt cheap. So a lot of people out there trying to buy Nubank and all this other stuff, that's great. Mercado Libre, fantastic business. If they ever are deeply discounted like Lululemon, then I'll go buy them. But I'm not going to buy them now because those are consensus ideas that are more expensive. So if you look at PAG Seguera, this thing's up 45% in a year, despite that Brazilian volatility we talked about. That's beaten probably most names in Mag7 except for Nvidia, maybe and maybe another one too. But so, what else? Let's take a look at the forward estimates. These are analyst estimates. I'm not a big fan of analyst estimates, but I do take a look at them to get a basic sense of I can handicap once I see this, right? So, here's the business, 3.2 billion in revenue, going to 3.9 billion in 3 years. And growth rate expectations are actually modest. I like this. And the realized growth rates are higher. So I think the analysts are wrong on this. I'm not sharing all my reasons why, and I'm not trying to do a deep dive case study on this, but I actually like this. Analyst expectations are low, so they can be beat, right? So that's a key to being a contrarian investor. What's your variant perception? I expect that the growth rates will continue at a rate that's maybe not as high as the past, but at least more in that direction than what you see here. So what else? How does this compare to where the analyst price targets are? Let's take a quick look. Well, yeah, I mean, look, it's coming into the lower bound now. We were buying around here. I mean, this is like a beautiful setup. This is a classic Lumina setup right here. So we really like this, right? I can own this thing for quite a few years, let it compound, not worry about it. And we have a good entry. So I'm not going to get shaken out of my position. That's important. So confidence in that position. We can sleep well at night. When you buy an expensive stock near the top, it's not actually a stable position because you might have a better entry in another asset or even in that asset. So you have to be more tactical then. But when you can nail a good entry, you're firmly established in that and you can hold that for a long time to come. So what else? Let's see. Got some questions and comments here. Thank you for the really nice words. I love that. I appreciate that. It's a value trap for the reason you highlighted. Well, okay. Here's an interesting question. Okay, about Lulu. So is it a value trap? Look, revenues are going up, earnings are going up. We just saw. Value trap is when the opposite. I'll show you a value trap right here. Let me show you CVS and Walgreens. This is a fun one. This is a really fun one. All right. Walgreens Boots Alliance. Okay, let's look at this guy. Okay. So forward PE 5.6. There's value. Is it a trap? Let's take a look. Okay. So revenues are going up. Interesting. Okay. What about net income? Okay, net income's negative. Boom. There you go. So revenue is a head fake. I prefer earnings over revenue, by the way, for all sorts of reasons I've discussed in the past. But yeah, this thing is it's losing capital, right? The cash flow from operations is shrinking. Do you want a growing business or a shrinking business? Compare this like CVS, right? CVS was a buy we did in May. Generally, I like betting on trends, secular trends and themes, secular growth trends that are enduring in nature. But I also like to barbell that with mean reversion ideas. If there's a dislocation, find the high quality asset in the dislocation. Pag Seguero is an example of that. Lululemon is an example of that, right? CVS is an example of that. Look at this. So 4P of 8. Now compare CVS owns United, by the way, right? Let's take a look at United Health stock. 4P 17.8. Right. I think that has ramped as well. How about Elevance? Elevance is a great business, by the way. If you can get it on sale, you should consider it. It's pricey. This would have been a good moment right here. Oops, I got to share my screen. Sorry about that. So there we go. So Elevance 4P 14, United Health, which is a consensus insurance play because everyone knows it's one of the best investments of all time. So everybody already owns it, which is why I don't want to. CVS, is it a value trap? Well, let's take a look. Now, they did make mistakes with Medicare Advantage. They've taken actions to remedy that. It's one of the easiest turnarounds. It's called you change your insurance policy, and then you wait for your customer contracts to turn. That's your turnaround, changing a contract. So revenue's up, net income took a hit or maintains cash flow positive. So the key thing here is when I'm looking at that net income decline, it's actually not even that much. Look at this. I mean, 7.3 billion. That's higher than 2022. the cash flow from operations here are taking a hit due to they enrolled too many unprofitable Medicare Advantage accounts. They had zero deductible policy. So it turns out that if you pay a deductible, people consume more healthcare. So they had increased utilization on healthcare, and they have one of the worst profit margins in the industry in their insurance business. But that's all because of their policy. They're going to fix that policy. And in fact, they did. Policy's fixed. Now we wait. But I got to wait 1 or 2 years. It's not a momentum play. If you own a momentum stock, you need it to perform right away. Otherwise, you should not own it. Right? It's like hiring LeBron James. If you hire LeBron James and he's got the flu for the season, you got to get someone else off the bench. But if you own a dislocation play like that, you just sit back and wait. It might be a year. It might be 2 years. CVS can do $5 billion in free cash flow and buybacks. They suspended their buybacks to preserve their rating from Moody's, which is smart. They're keeping a low cost of capital, but they're disciplined. And in a year from now, if they resume those buybacks, then that rating goes back to a historical valuation rating for CVS. Let's go take a look at that. Let's go take a look where CVS normally would the historical valuation, by the way. It's at the 6th percentile level. It's dirt cheap. Free cash flow by market cap is 11%. Okay. That's a big number. No Mag7 name has that. I know it's not the perfect comparable. Historically in a name like this, you would see the valuation multiples in the low teens. Multiples for this category is cyclical, as it is with many industries. And we're on the trough of that cycle. You're supposed to buy the trough. And you may have to wait 5 years to get a full normalization of the re-rating, but there should be a good inflection in the next year or two. That's my thesis around CVS. So I like that. This is like one of my boomer trades as well, right? You think boomers are going to buy pharmacies on Amazon? Well, maybe they do. I mean, retirees and grandma and grandpa, but they still like to go to the store, and it's linked to Aetna. Amazon doesn't have Aetna. There's a big difference there, right? So that gives a competitive advantage. I love the higher lows pattern setting as well. It looks like it's breaking out from these moving averages. Maybe this thing moves. I posted last week another entry around this one. It was pretty good around there. What else in small caps? I'll show you some of the names I own. I've written about this before already on Twitter. I'm not sharing anything I haven't before. But Innova, look at this. Look at this guy. Retail lender up 6% today. Boom. Ford P8. Okay, this is going to blow your mind. Check this out. No one's talking about this stock on Twitter, by the way. No, you probably have not heard about Innova. They're a retail lender. They do subprime lending. If it wasn't subprime lending, Buffett would acquire this business. Their free cash flow to market cap yield is 64%. Think about that. This is a 1.85 billion market cap company, and 60% of that market cap they generate in free cash flow. And what do they do with that? Well, they buy back their stock with 15% of it. They're on exit liquidity. I have a large position in this stock. I mean, I love all my stocks, but I like this stock too. So what an interesting business. Okay. Retail lender, they compete with Lending Club and SoFi, and they make more money than those guys, because when people get a loan from a retail lender, you have to look them in the eye. You might know their character in the community. Think about credit, it's character, capacity, covenants. So this is a really interesting business, right? How about ASPI? This is an advanced materials company. I interviewed the CEO a few weeks ago. This is quite something. We were accumulating this range right here. And then they did a secondary offering. The stock tanked and it turned around and went back up. This is actually a pretty interesting move. We'll see what happens from here. It's a long-term hold for me. This is a bit off style for me because this company actually doesn't make earnings yet. But I try to leave room in my portfolio for one speculative bet. This is like a venture capital bet for me, where I think there could be a good opportunity. What else? Okay, here's another one. This is from our stocking stuffers portfolio from earlier in the year. We wrote about this in late December. This is American Public Education. They train nurses. The world needs nurses. We need nurses, right? I love the theme. I love the valuation. By the way, take a look at the stock performance on this thing, all right? Use 12.5. It's gone up 100% year to date. This is a Lumina stocking stuffer pick, one of our best. It's been up 300% in the last year. Okay. It's a small cap. It's cheap and they grow earnings and it has momentum and it's not a tech stock. If you're addicted to tech stocks, there should be some kind of rehab for that. I love tech stocks. In October, I love tech stocks. That's when you should be buying tech stocks, right? So what are they doing? Free cash flow divided by you're seeing my favorite metric here. They generate 11% in free cash for their market cap every year. And what are they doing? They're buying back some of their stock with it. And it's cheap relative to history. And there's a thematic lineup. So, if you can stack those edges, that's great. We were, by the way, this is a hard name to get. We owned it this year. We have new accounts that sign on. You can go to luminawealth.com, by the way, self-plug if you want to be a customer. But, you want to nail those entries. Like, I don't want to buy it like here. I want to buy it like there. Buy it there. I want to buy it there. What I noticed is that it was very hard to get our entries in. And that is a telltale pattern that people want to buy. And if you can link your top-down analysis, your thematic analysis with a fundamental analysis, with like a technical entry analysis, and then monitor the trade execution, you stack edges. That's a different kind of information. Normally, an investment group, they separate out all these functions and the mind share doesn't happen. And they have one guy doing consumer discretionary, one gal doing consumer staples, and they all have the best idea and they cannot be integrated in a coherent way, much less thinking about the technicals and the entries and what's the call option activity, what's the sentiment, right? So that fragmentation of the thought process creates our opportunity, right? I showed you an example, like dollar rolling over. How do I get long Brazil? What's the best stock in Brazil? What's the best entry? Classic example, right? Or Shineri. This is really quite interesting, right? We wrote about this 2 months ago. So Shineri, all right, this is called the follow the money trade. I like to follow the money trades. You just, interesting. So Shineri, first of all, it's a great business. It's the leader in liquid natural gas production, and Europe needs liquid natural gas. And it's the least dirty fuel source, cleaner than energy, cleaner than coal. Utilities need an energy source. They're not going to, create CO2 out of oil. So what's the right energy source? Liquid natural gas. Who's the leader in the market? Focus on the leader in the market. Shineri. Shineri is the leader in the market. So we pick that up right here, that green line, like right on that red line. Boom, nailed it. That's called a good entry. You can see it's a good entry, right? It's consolidating around here. And that it was at a $45 billion market cap. Or maybe I got that math wrong. No, it's 40 billion now. I think it was 35 when we bought it. Sorry. Yeah, we can do the math here. Yeah, that was good. And again, back to the Trump bump, if the Trump administration is elected, I'm not making a political comment here. I'm just trying to parse reality and make good investment decisions, right? But if that happens, then these guys can actually grow at a faster rate because there are restrictions on your ability to export liquid natural gas. You need certain permits in place. And to do that, you have to go deep. You can't just look at a chart and say, chart go up, I'm going to go buy the breakout. You have to know that you've got a fundamental story underpinning this, right? So what else here? If you have any questions, let me know. So then we talked about small caps, Brazil, equities, crypto. Wow. I mean, quite an interesting setup there with JD Vance as the VP. I mean, he owns Bitcoin, right? So, if banks are permitted to handle crypto and provide distribution and engage, that's quite a sea change, right? So I wrote about GLC last week. I got in like 2 days early, and then Germany hit like max sell, but we hung in there and we're good there, which is great. But it's going to be an interesting asset to watch for sure. When you're looking at Bitcoin, though, you should look at other commodities at the same time. You should be looking at uranium, for example. You should be looking at the direction of the US dollar, which is going down. All that will help commodities, right? So there's uranium. It's almost indistinguishable from Bitcoin, right? So whenever I'm looking at an idea, I'm looking at kind of like what are the comps to this idea, either from an opportunity cost of capital or how are other ideas that are related in the same sector performing, right? So, oh yeah, what's the name of the subprime lender? Yeah, oh, yeah, that's a Nova. Good luck on getting an entry now. This thing ramped, right? This thing ramped. I struggle with chasing. It's just not in my nature. I'm someone that likes to pre-position, right? So we were accumulating Innova, and yeah, that thing ramped. I don't. By the way, take a look at how Innova did during the Trump administration, the 2016 to 2020 era. I'm going to do a 10-year chart. So that is around here, 2016. That's like January 2016, right? And it ramped. Why? Because the Trump administration be less critical of subprime lending. That's why. All right. So this is actually a certain bet indexed to that theme as well. I think it's a fine business kind of regardless, but that adds a little bit of a kicker, which we've been seeing here. Right. So, you know, they're one of their competitors, One Main Financial, by the way, fine business. Nice business too. I don't own this. These are competing assets. You should look at both. I like the free cash flow on Innova. That's why I own it. So what else? You all have any other questions? Feel free to let me know. Like owning a subprime lender is definitely not consensus, right? So what else? Look, I think this Friday, options expiration is a key date to watch. As I mentioned, that could be an inflection point. We shall see, especially in the negative momentum rally and the more speculative names. Tech earnings, we got to keep an eye on it. Oh, we saw United Health report. We saw bank stocks report. The earnings are fine, but the stocks dropped. So, you know, that's a note of caution, I would say. You know, when things are low, I want to buy. When things are expensive and running up, then I start to get a little bit more. We've been a part of this, which has been great. I've written about small caps are going to ramp, expect the Trump pump, expect the energy rally. But now I'm starting to get a bit more cautious now, right? So what else? I'm going to share some quick themes that we are looking at. Let me share this. Every week we write a positioning document. It's prepared every Sunday because you don't have time to think Monday morning. You have to be in action mode on Monday morning, right? So I'm not going to share all the contents of this with you, but this is an excerpt, actually. We go through different research, try to find different ideas there. But look, the liquid most short basket, this is a thematic basket that Goldman Sachs publishes, had its best week, 17% up year to date. This is outperforming the S&P 500 year to date now. And most of the move was last week. This is a mean reverting series, meaning when it goes up, generally goes down. In fact, a good proxy for this, let's take a look at ARK, right? Because ARK picks highly shorted stocks that hedge funds like to short because they're terrible businesses, right? This negative momentum rally, and I pointed out like 2 weeks ago that you should expect ARK and SoFi and others to rally. That's what's happening. It's a negative momentum rally. But this is ARK last year. Take a look. So ARK last year peaked when ARK peaked Feb, these dates, Feb 23, July 17, 23. That's almost the day where we are today right now, right? Okay. Jan 24. All right, now I'm going to switch over to the S&P 500. By the way, you also just invest in the S&P tax loss harvest, and don't worry about all the stuff I'm talking about. Life simple. All right, so if I pull up this chart here, we talked about Feb 23, early Feb, July. It's peaked 2 days after ARK peak. Actually, no, right on the same day. There you go. Right around there. It lagged about a week or so. It's about a week off. But in general, you know, those speculative names and that short interest rally, when those names move, that's a sign that it's last call at the bar. Does that make sense? Now, is ARK a good timing signal this year? No, it's not. Why? Because people know ARK is garbage. They're this year. right? ARK is trying to kind of reposition itself, but what you have to do is find where did the speculation move. Now, there's some of this coming up at the end, right? It has benefited somewhat, but it's certainly not as pronounced as it was in these other areas, right? ARK was a great timing tool. What you have to do is find where is the speculation hiding? Where is the fast money hiding, right? So, I think it's hiding in Tesla. That is my claim, okay? I think it's also maybe happening in Apple, perhaps, part of the negative momentum rally too. We'll see. But certainly Tesla, maybe not Apple. Tesla, it's a cult of personality and all this other stuff. Oh, sorry, Palantir, obviously. I should have mentioned Palantir. Those two names, right? So take a look at Palantir and see where this is. So let's take a look. July 23, right? There you go, peak. There's some noise here, kind of rallies again, and then goes into that October correction. So yeah, there's a lot of noise around this one, but I do think there's a lot of speculation hiding in Palantir. So this is a good name to watch along with Tesla and a few others. There's no single magic indicator to get a sense when things are getting a little too hot. Look at this. What did this peak? March 7th. That peaked March 7th and March 8th. I know that date. I'll tell you what happened on March 8th. I'm going to pull up the semiconductor index. Okay. I have March 8th plotted here. That was the day after the State of the Union, actually. Okay. So here's State of the Union, March 8th. And what happened? That was a correction. It lasted until April 24th. Right? So Palantir is a good sense of measuring where froth and animal spirits might be. Right? What else? I think we covered a lot of ground there. That's a lot of fun. I hope you found that helpful. Let me think what else I can share with you. There's a lot in this positioning document. I'm trying to find a way. If there's any way I can package what we discuss. We do this every morning, 2-hour conference call. And I think it's pretty interesting, but we talk about ideas and themes like this. The big picture, here are the ideas. The number one question you should ask is the rotation to small caps a one-off or a true move? I think it's a true move. That's one. Second, I think best in the rest theme, which has been driving the markets this year, is expensive. We're seeing some weakness in that. Look at FICO, look at Costco, look at one of my favorites, Meta. Third, what's happening? That softening in the growth slowdown, non-farm payrolls we saw last week, CPI, that's motivating participants to say Fed cuts are coming. Okay. And so that's causing a breadth expansion because these are weaker companies that need rate cuts. Mag7, those are some of the best businesses in the world. Okay. What else? On the technicals, momentum's working and negative momentum's working. That's called melt up. Now, melt ups eventually stop. You want to enjoy it when you're in it. Don't chase it at this point. But be thoughtful about your off ramps there. We saw a lot of gamma call activity in those Mag7 names 2 weeks ago. That's now fading off. The Mag7 names are a bit weaker now. Animal spirits on that side and sentiment, you're seeing a lot of shitty companies rally. You see bad AI stocks like Infosys. Infosys is like a bullshit AI story. It's rallying. Best Buy is a retailer that's probably going to go the way of remember Circuit City? Circuit City's gone. Does not exist anymore. Right? Went bankrupt. Why doesn't Best Buy go in that direction one day? Well, it's ramping on AI PC narrative, which might or might not happen. I don't know why people are going to buy an AI PC. I still don't see a use case. I see a use case for Qualcomm that's going to power that. So what else? Let's see. Taking a look at some of my notes here. What else? I mean, overall, look, I think we finished the year and it's going to be a strong, strong year. I think the analysts are underestimating where the S&P finishes this year. I can see it because we see it at the stock level and the mid caps and the small caps. And they, in 2021, the forward PE for small caps was around 21, which is where mega caps are. So why can't they re-rate higher? and they still have more to go. So I think we'll see that happen. I'm keeping an eye out for weakness around August, September. It's almost like the same setup as last year, actually. You've got a peak sentiment moment now in the markets with rate cut expectations coming in and kind of RNC news and this Trump bump stuff. And, when everything's priced in on the upside, then there's more risk for disappointment. You saw that in the earnings. It's one of the reasons why I've been rotating to these mean reversion plays like CVS, like Lululemon, because I think they have less downside. Okay. We will call it a wrap. I hope you enjoyed that. If this was fun and useful, let me know. I can try to do these more often. And please send me questions. Those are the ways I can make sure I focus on what you all have interest in. All right. Take care. Be well.